Hello and happy Friday, dividend growth stock investors. It's Colby, the DGI Crab. So the markets are taking a beating over these past few weeks, and I just wanted to provide you all with a bit of an end of the week pep talk for anyone out there that may in fact need it. It's always scary when we see the stock market going through a correction. A lot of things are trading down right now, regardless of what sector that you're in. And that also has a very similar impact on the types of ETFs that we focus on around here, whether it be your S&P 500 funds or your dividend focused funds like SCHD or VYM. Kind of doesn't matter right now what you're buying. For the most part, things are looking pretty down. And again, people tend to get a little bit scared, a little bit nervous when they see things like that happening. So I want to talk about this concept of the roller coaster going up and down. It is win-win for you as a dividend growth investor. When the markets are up, people are really excited. Most of your individual positions, if not all of them, are trading very comfortably in the green. Feels good, but so what? If you're a long-term buy and hold dividend growth investor whose goal it is at the end of all of this is to have enough money coming in dividends to fund your retirement, then the overall share price of whatever it is that you're buying really doesn't matter a lot at the end of the day because you're likely not going to be selling shares in order to live off of. Maybe you do here and there if you want to, but your primary goal, if you're a true DGI investor, is to get to the point where you have that financial freedom through dividends by buying quality. That's what I emphasize here on the channel. That's why I only am focused on 60 high quality dividend growth stocks with long track records of increasing their dividends year over year, regardless of what the overall market is doing. Now, right now, when it feels like we're on the downward trend of the roller coaster and things are going down, and maybe you have positions in your portfolio that are trading in the red, this is good news for you, regardless of the age that you might happen to be. Say that you're already in retirement, you're in your 50s, your 60s, your 70s even, and you've built up a portfolio of high quality stocks and ETFs that are funding your retirement. Doesn't really matter what the share price of this stuff is, so long as the dividends aren't getting cut and they're continuing to go up overall. You don't have any worries whatsoever about the overall value of your portfolio. It's how much dividends the portfolio is generating that you're primarily concerned with. And if you're not at that point yet, you're a younger investor, your 20s, your 30s, your 40s, early 50s, you're still working your way to financial freedom. This is a fantastic opportunity to be buying value for your money, because if you're more primarily focused on the amount of money per share per year you're getting with the stock purchases that you're making, you're getting so much more bang for your buck in a down market right now that you can acquire more. You can increase your yield without sacrificing quality for the hard-earned money that you are putting into the market. Please remember, millionaires are made in stock market slumps. So there's two mistakes that you can make here, you guys. First of all, you might be looking at the prices going down and wanting to pump the brakes a little bit on your purchases. You might say, well, there's so much uncertainty in the market right now that I'm going to slow down a little bit, hold some more money in cash, and see if I can't get even better value if I wait. Sometimes that might work and sometimes it might not. We don't know if the markets are going to be down for a week or two, for several months, or even the next couple of years. There's no way of knowing. If you had that crystal ball and you knew that, then you might as well just like take out a bunch of loans and invest a crazy amount of money all leveraged up because you're going to be right because you've got that crystal ball. But that does not exist for any of us. The mistake that you could make here is not aggressively investing into the market while things are down. And that's why I think spreading your money around to multiple positions is a good idea. because you might be wrong about one or two. But if you've got a dozen, 15, 20 different positions and you're right on the majority of them, your portfolio is going to do great, especially if you're leaning into it in times of uncertainty. Now, the worst mistake that you can make here is to panic sell. And this can happen a lot with younger investors who get really excited about getting their money in the market. They haven't experienced a correction like this before, and then the next thing you know, they panic, they sell for a loss, and just say, well, this investing thing is not for me. It's too volatile, or the stock market's a scam, or it's fake, and you can't make any money that way if you're a little guy. And I'm here to tell you, you absolutely can in this day and age. Now, I will be going over the 4 tiers spreadsheet on Sunday, so I'm not going to go through each of the 4 tiers here, but what I wanted to do here for you all is just kind of show you at a broad level what we're looking at here in terms of all of the stocks amongst this group of 60. There are, and if we sort by this valuation tab here, where I'm comparing the current day yield to the 4-year average dividend yield, there are a ton of options right now that are yielding at least 30% higher today than their 4-year average yield. So let's think about this in other terms if we really need to just kind of step away from the market for a little bit. Let's say that you're in the market to buy a house. Could be an investment property, or maybe it's a house that you're going to actually live in your primary residence. Let's say that that house is, I don't know, let's call it a $250,000 house. Some of you out there on the east or the west coast might think that that's a shoebox we're talking about. Maybe some of you in other parts of the country think that that's a pretty impressive house. But let's just say you're looking at a $250,000 house, and then for one reason or another, you decide not to pull the trigger on that house. You're looking at it and you say, well, that's a pretty fair valued house based on how much other houses have been selling for in that area, the condition it's in, whatever. And then 3-6 months later, there's a housing market crisis. Property values just start dipping, and you turn around and you realize, oh wow, that house I was looking at a few months ago is still on the market, and now I can get that house for $200,000, and you pull the trigger. That's a difference of $50,000. It could make a huge difference in your overall retirement plan, getting that great deal at the time that you purchased that house. Well, the stocks you should really think about, the dividend stocks that is, you should really be thinking about in the same way. For every share of Nike, for example, that you purchase, you're getting $1.60 per year per share of Nike. This is your rental income, let's say. Would you rather have purchased Nike a year ago when it was trading for $95 to $100 a share, still paying out basically the same amount? Or would you rather have it now in the low 60s? You're getting almost twice as much income for the money that you're putting in now as you would have gotten when it was trading too high a year and a half ago. That's the overall thesis of this channel, is we want to focus in on quality stocks that we don't expect dividend cuts to come from, that we actually expect annual dividend raises year over year, and we want to make sure that we're acquiring that income for the lowest amount of money possible. Another one, Target. Target at one point in time was trading well above $200 a share. It was yielding 2%. I think there were points in 2021 where Target wasn't even yielding as much as 2%. But right now, this is one of the stocks going through a major slump in these uncertain economic times where consumer spending is down, and the yield that you can get that for is now well over 4%. So it makes a huge difference, the timing in what you're putting your money into, regardless of what dividend stock that it is. Now, I still maintain that you shouldn't be reaching for high yield just because there's high yield there. You want to focus on quality, and you want to focus on things that have a dividend growth rate that's appropriate for your age range. So While right now, T. Rowe Price yielding comfortably above 5.5% looks like a pretty good investment for someone in their mid to late 40s, maybe early 50s. The dividend growth rate on T. Rowe Price over these last few years probably isn't good enough for somebody that's 25. But right now, just about any of these in the green are a good solid investment for just about anybody, depending on where they're at in their financial journey. Focus on quality. Don't get caught up on share price or whether or not your overall position is up or down. You are acquiring dividend income in order to live off of, whether it be 10 years, 20 years, 30 years in the future, or even just a couple of years from now. So rejoice, work some extra hours over these next few months. If you have an hourly job where you could pick up overtime hours, this is a great time to work those hours if you can get them. Or if you are somebody that's a side hustler, you're driving Uber or Lyft, or you're delivering things with DoorDash, or you just pick up some extra side job somewhere in a restaurant or a retail store or whatever to get that extra money to invest. This would be an opportune time to do so. 2024, I've been saying all through 2025. 2024 was a very hot year in the stock market. There were not a ton of consistently good individual single stock deals that were presenting themselves, especially if you were trying to buy quality. And the ETF prices just continued to go up and up and up. So it was harder to get good solid value from your dividends in that regard as well. Now is an excellent time to jump in, take advantage of this correction, because 4 years, 6 years, 8 years from now, 15 years from now, whatever your time horizon is, you'll look back at getting some of these stocks at the prices that they're at right now. And probably what your thought process is going to be on most all of them is, wow, I can't believe that back in 2025, I was buying shares of Hershey for $169, or Genuine Parts Company for $118, or Pepsi for under $150. You'll just be blown away by it if you have a longer time horizon in place and you can take yourself out of the headlines and out of panic mode because of the uncertainty that we're dealing with right now. Nothing lasts forever. There's almost always going to be some good deal to buy amongst this group of 60 stocks. And if you are not somebody that wants to track individual single stocks, then focus in on those ETFs and enjoy the fact that those are now all, for the most part, trading lower on a per share basis as well. And get yourself to financial freedom. Keep track of this stuff in a spreadsheet if your brokerage account doesn't track your projected dividend income for you. And instead of worrying about the overall value or dollar amount of the account, which is what all of the brokerages are going to put as the front-facing metric when you first open them up, just pay attention to how much you're receiving in dividends. Keep track of the dividend increases, the dividend reinvestments, and you are going to see that particular number, if you're sticking to quality, regardless of what the market's doing, continue to go up, 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 up at a nice 45-degree angle. Hang in there, you guys. This is Colby, the DGI Crab. Email me your questions, dgicrab@yahoo.com. I'm always happy to answer your questions via email or even make a video response about it if it needs to be gone over a little bit more in depth. Hopefully, for anyone that needed this pep talk today, you found the video, and this is going to have you feeling a lot less apprehensive about what's going on in these markets and excited to get out there, hustle, come up with some more income to put into these markets and get yourself some deals, because there's plenty of them out there right now. See you all on Sunday when I go over the 4 tiers, get a little bit more in depth as to what each age range ought to be buying right now. Till next time, y'all. See ya.